About today, super tankers and tanker rates. So, been covering a lot about the Strait of Hormuz, but one of the most interesting things has been the tanker market. But what's been happening both with the stocks of tankers, but also with the rates of the tanker. So tankers kind of break down into three general characteristics. One of them is small feeder type vessels that operate very coastally, and because of their limited carrying capacity, you don't want to run them long distances because half the voyage is empty in ballast. The other two types are a mixture between crude carriers and refined products. Crude carriers tend to be the big size. Now, the biggest is what is referred to as ultra-large crude carriers. These are 400, 500,000 deadweight ton vessels. I mean, they're behemoths. And to tell you the truth, they don't operate too much anymore. I think there's like one or two still operating around the planet, but the most of them have been converted into floating storage and processing facilities. You don't see ultra-large crude carriers out there. Now, we do see a lot of very large crude carriers, VLCCs. These are typical over 300,000 deadweight tons. They're carrying over 2 million barrels of oil. These are used for long distances, and they get a huge economy of scale by carrying crude oil, because crude oil is fairly, believe it or not, the cheapest of the oil products that are out there. So you want to get the large economy of scale. But one of the groups not shown on this chart here are Suezmax tankers. Now, these carry about 150,000 tons of crude oil, maybe about 1 million barrels. They are operating, as it says, through the Suez Canal, but that is kind of the smallest crude carrier you'll find. And then you get into refined crude carriers, and these operate in between the medium range, what are called MR tankers. These are fairly small, 25 to 50,000 deadweight tons. Your LR tankers, which are your long-range tankers, and they come in two different categories, 1 and 2, roughly about 60,000 deadweight tons up to about 100,000 deadweight tons. And then you have your Aframax, which are kind of right in between there, and the Aframax are running right at that 100,000 deadweight tons. LR2s can be a little bit bigger. But that kind of breaks down the different types of tankers that are out there. Now, typically, the LR tankers move refined product over long distances. Medium range tankers operate them over, guess what, medium range. However, what we saw was, because of the shutdown of the Strait of Hormuz, all of a sudden these medium range tankers got a lot of money to be able to go long distances. Typically, those ballast voyages, when you're empty, were not profitable. So you couldn't make enough money on a long haul to make it profitable. Well, that kind of got all flipped on its ears. However, what we're seeing is a restabilization of the rates, hence the reason for today's video. Last week, May 6th, Greg Miller over at Lloyd's List posted this story: Hormuz crisis slashes very large crude carrier volumes by 36%, but voyages are longer. So he makes three key points here that I want to emphasize on. So the first point Greg makes: crude and condensate exports on the very large crude carriers averaged 14.4 million barrels per day over the past 8 weeks. Story from early May, so we're talking about March and April here. That's down 36% versus the average in January 2025 and February 2026. So that's according to Vortex data. So we're seeing that drop, a big drop, almost a third of the amount of crude oil being carried on these large vessels. Makes sense. We've seen the displacement being caused by the shutdown of Hormuz. 20 million barrels of oil a day went offline. We've been able to offset that with 1 million coming through Fujairah and about 4.5 million coming out of Yanbu. So Greg's second point is the Atlantic to Pacific voyages accounted for 35% of crude export volumes on VLCCs in the past 8 weeks versus just 22% in that last time period of January 2024 to February of 2025. So that 13% uptick we're seeing is because of the relocation of very large crude carriers from the Persian Gulf over to the Gulf in the United States. We're seeing crude oil being picked up in the United States. We're seeing it picked up in Mexico. We're seeing it picked up off Venezuela, also off Nigeria, Brazil, and other areas. So this is that Atlantic to Pacific voyages. Now remember, on very large crude carriers, you've got to go around Africa. That's a big issue because of the distance involved. It takes you over 50 days to go from the Gulf of the United States over to the east coast of Asia. His last point deals with the ships trapped in the Persian Gulf. Tanker owners require, quote, high level of credibility, unquote, on the Hormuz situation and for trapped ships to exit first and demonstrate safety. Now, that's coming from one of the biggest tanker carriers in the world, DHT. That means that they're not going to risk their tankers coming through the strait until they know there's a margin of safety for them. Now, we have this story from Shishin Shen, also over at Lloyd's List. Tanker stocks slide as Hormuz-driven rally shows cracks. So Chinese shipping stocks, yes, there are Chinese shipping stocks out there, fell on Monday, led by tanker shares. So COSCO Shipping Energy Transportation, which is one of the world's largest tanker owners, dropped 3.1% on the Hong Kong exchange and 1.8% on the Shanghai exchange. Another state giant, Chinese Merchant Energy Shipping, fell by 2.2% in Shanghai. The two companies together control about 100 VLCCs. The Shanghai-listed products tanker operator, Nanjing Tanker, fell by 4%. Now, according to Portio, the market is reaching an inflection point with sliding rates and falling demand. That brings us to this story on 18 May by Greg Miller. VLCCs are once again outperforming Aframaxes and product tankers. So the Atlantic Basin VLCCs have been holding steady at over $100,000 per day for the past month and are now higher than the VLCC rates in the Gulf of Oman and Yanbu. That's according to BRS shipbrokers. The U.S. Gulf to Europe Aframax index was $53,421 per day in Monday, which is just crazy that it's at that rate. However, less than a quarter of its peak level back in March, which was insane. I mean, back in March, the rates, and I'll show you them here in a second, were absolutely insane for nearly all tankers. And then finally, U.S. Gulf to Europe MR Tanker Product Index. Now, MR tankers don't usually like to do long voyages. MR Product Tanker Index is at just $6,515 per day. It was 14 times higher in late March. The index recently hit its lowest point in 14 months. All right, let's break down Greg's story there just a little bit on each of those three facts and take a look at some of the data, because Greg always includes data in his reports. So Greg pulled this data from the Baltic Exchange. So this shows you from the beginning of the year up until 18 May, the rates for different tankers. So these are MR tankers. These are those medium range tankers involved in the U.S. to Gulf Europe. You can see how they were banging at a ridiculous rate there of about $100,000 a day. I mean, just absolutely insane until it falls off a cliff here, literally bottoms out. And this has a lot to do with the demand destruction that we're seeing, is that demand is going away because everybody's retooling right now and restructuring in what type of fuel they need, also in how they're getting their fuel. And MR tankers are very smaller tankers. They're on the smaller side, so not very efficient for carrying them. And what we expected to see was MRs were kind of filling in very quickly, kind of, patchwork, bucket brigade type stuff. And now that demand is falling off. What you see is the rise in LR tankers, much larger tankers, still carrying clean product, but they are at a much higher level. And so again, more efficiency there. You don't have to use smaller tankers. You can use larger, more efficient tankers. And here you see Aframax on that same US Gulf to Europe run. Those LRs were for the Med to the Asia run. But again, you see that massive spike all of a sudden there in March to April, when all of a sudden you needed to get clean product over to Europe. That huge jump up. The next two, the Suezmax and the VLCCs, are dealing with crude oil. So Suezmax kind of follows that route right there. You can see those big spikes that happened in March and into April with rates that were just astronomical compared where they are. But look at where they've fallen off to. They really haven't come that far down than what they were pre-conflict. So they have basically stabilized, but it's the VLCC, the very large crude carrier, that Greg's making the point here in his story. Here's that chart. I'm going to clean it up here and just show you the very large crude carrier kind of highlighted right there. And you can see that is the U.S. Gulf to China coast. So again, kind of flattening out here back to those levels prior to the U.S.-Israeli attacks on Iran. So a stabilization in it, but there's a couple of factors that are leading to this. So this chart shows you very large crude carriers by basin, and basin means where they're operating out of, the Pacific or the Atlantic. And you can see down here, this is the Atlantic Basin numbers here where they're at. So Atlantic Basin has been fairly standard. I mean, it hasn't changed too much, a little bit of an uptick. What we're missing here is that Pacific Basin. And that is the loss of the Persian Gulf, and that's having a massive impact. We're seeing a bit of an uptick, as you see there, in the Atlantic Basin. This is in weekly volume in millions of barrels per day. But we haven't seen really the massive uptick yet in the Atlantic Basin because, again, it takes a while to shift tankers over into the Gulf Coast of the United States, load, and start deliveries. It's almost 2 months of a sail. So take you over here to marine traffic. What you're looking here is very large crude carriers. I cleaned it up and I just have the very large crude carriers and above. You'll notice a couple of things. Number one, tankers either stuck inside the Persian Gulf or waiting to get into the Persian Gulf. But the big thing is that big line of tankers coming around the southern tip of Africa down there, which is the Cape of Good Hope route. Now, Greg talks about 3 really important points. I want to read this for you from Greg. Theoretically, the continued effective closure of the Strait of Hormuz should drive more VLCC tonnage to the Atlantic Basin. And the shortfall of overall cargoes globally should put downward pressure on rates. This hasn't happened yet, and he identifies 3 reasons. First, the growing number of cross-basin VLCC voyages around the Cape of Good Hope, again down there, both laden and ballast, is keeping tonnage occupied on longer legs. So we call this ton miles, the longer distance it takes to haul a ton of cargo. And what's interesting about ton miles, you got to be careful about it, because while you add miles, you decrease tonnage, because the voyage it takes is much longer. I mentioned this to you before. It takes about twice as long to go to the U.S. Gulf Coast as it does to go to Saudi Arabia and load. While you're going double the voyage, you're doubling the miles, you're doing half the tonnage because your ships can't make as many voyages. Second, there's still over 60 very large crude carriers still stuck inside the strait. So a good chunk of the VLCC fleet is really occupied inside the Strait of Hormuz. You can't get it out, it's bottled up. And obviously, a fully loaded tanker, there's a lot of risk in trying to sail it out of the Strait of Hormuz. It's not so much damage to the ship. I mean, VLCCs are really tough vessels. They're extremely tough. They're almost impossible to sink because of their strength and their size. But the fear here is damage to the ship will cause environmental damage. And that's the big concern, because then the company is stuck with that. And then finally, nobody wants to give up on the Strait of Hormuz. So what we're seeing is a lot of ships sitting there. Earlier this week, they counted 55 VLCCs in ballast sitting outside the Strait of Hormuz. This figure does not include vessels positioned further afield, like off Sri Lanka, India, and Singapore. When you put it all together, there are 63 laden VLCCs trapped inside the Persian Gulf and over 55 waiting to go in. Add to it, you have about 36 holding at Yanbu. That is the port there off the west coast of Saudi Arabia, where ships are loading. But again, you have restrictions there. You can only load about 4.5 million barrels per day, even though you're moving 7 million barrels by the pipeline. There's just restrictions in the port. That puts about 155 VLCCs effectively locked in or out of spot supply. Now that's out of a global fleet of 920 VLCCs. So that's 17% of the world fleet. Now, if you take out dark fleet tankers, that brings us down to about 700 VLCCs. So about a fifth of the world's fleet is occupied at this time. And that's what's keeping the VLCC rates artificially high right now. Because of that, you've got a portion of the world's fleet that's not in business. So ship brokers, ship operators are in this really big quandary. Do you send your VLCCs from the Arabian Gulf, Arabian Peninsula area over to the United States, to Brazil, to Nigeria, to Mexico, to Colombia and Venezuela? Because if all of a sudden the Persian Gulf opens back up again, there's going to be a tsunami of ships heading into the Strait of Hormuz to go load and get that oil out. Because again, the only place that can replace that shortage is the Persian Gulf. That is the big issue that we know of. We looked at the IAE report from May. They looked at 5 key points. One of them they looked at is demand, where demand is going to contract, they know of, because supply being down, everyone is cutting back, and so refineries are cutting back on the demand into them as they scale back down. Second, supply is going to go down. That's the other big issue. Obviously, if your demand goes down, your supply goes down. Refinery crude throughputs are forecast to plunge down. while oil inventories are continuing to draw down. And then finally, of course, the last thing is going to be price. All these issues play a vital role in understanding what is happening with the tanker market right now. Tankers are operating in a very unique environment. No one has ever seen this sort of demand supply disruption, at least on this scale. You got to go back to February of 2022 when all of a sudden you had Russia invade Ukraine and you had the actions by the G7 and the EU to sanction Russian oil, which, by the way, the US just unsanctioned Russian oil again for another 30 days. So you got to go back to February 2022 to really see anything similar to this. And rates were high then. And what we're seeing is very much a repetition of that. The question right now is uncertainty. Nobody knows if the Persian Gulf is going to open up and when it's going to open up. And that is causing doubt. We saw this when Ever Given got stuck in the Suez. Ships piled up on both sides of the Suez. And nobody wanted to take the gamble and go around Africa because they were worried that at any moment Ever Given would get unstuck. Yes, unstuck, the official word of removing Ever Given from the Strait of Hormuz. They were not sure when it would get unstuck and then open back up. And lo and behold, 6 days in, it opened up and we had the mass rush through the Suez Canal. Some ships did go around, but those actually found themselves at a disadvantage because they were facing ships coming out of the Suez Canal. So you had this kind of bum rush into ports in Europe and Asia. This is going to be a similar issue. If all of a sudden a deal is brokered between the US and Iran, then all of a sudden this opens up. Although that is not looking very good right now. I'm going to say there seems to be no indication, at least I'm seeing, of any sort of resolution. I mean, you have Iran kind of trying to formalize their control of the Strait of Hormuz. You've got the US and China sitting there saying they're not going to acknowledge any sort of attempt by Iran to set up the Persian Gulf Strait Authority and kind of get administrative fees, tolls from that. This is a mess. It's a huge, huge mess, and it's going to cause massive disruption in the energy sector. Understand, in the United States, in Europe, and a lot of kind of developed countries, they're going to be able to handle this by just increasing costs. That's what they're going to do. It's going to be a burden on customers, but there's not going to be wholesale shortages. It's in underdeveloped and developing countries where you're going to see the greater disruption. That's going to be where you're going to have shortages. We're already seeing that. We're seeing restrictions. That's where you're going to start to see that because the developed countries will just pay more. And unfortunately, that's the burden that customers will have to handle. I hope you enjoyed this vacation edition of What's Going On with Shipping. If you enjoyed today's episode, hey, take a moment, subscribe to the channel and hit the bell so you'll be alerted about new videos as they come out. Leave a comment, share it across social media, and if you can, support the page. How do you do it? Well, you can give it a big thumbs up.